Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into Rush Enterprises' latest financial report. Get ready for a ride because this report has more twists and turns than a Texas highway. Rush Enterprises, a big name in commercial vehicles, just dropped their first quarter report, and while the numbers look okay on the surface, there's a bit more going on than meets the eye. But before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come share your opinion. Let's start by looking at the company's balance sheet, which is like a snapshot of what they own and what they owe. The most important thing to note here is that their total assets are up slightly from the end of last year. We see about $62 billion at the end of the previous year. It's not a huge jump, but it means the company is still growing. One key item to notice is this is a measure of the money owed to them by customers. That number has decreased to about $295 million. This means they've been collecting payments, but remember, less money flowing in can mean less money coming in. Kind of on the other side of the balance sheet. The company has a lot of debt, specifically $1.8 billion. While they managed to keep that number relatively stable, it's still a massive figure they need to manage. Now, let's look at how Rush Enterprises actually made money. The income statement shows this. Total revenue was about $1.85 billion. The number is slightly less than the same period last year. Was $1.87 billion. That's not necessarily a good sign because the company is selling less. A key area that took a hit was aftermarket products and services. Error down from $649 million to $619 million. This means there's losing customers somewhere. New and used truck sales remained mostly stable. Up to $1.13 billion, it was $1.12 billion. Now looking closer, it seems like it's costing Rush Enterprises more to sell their products. So how does all this affect the bottom line? Net income, which is the profit after all expenses, was about $60.3 million. It's down from $71.6 million the year before. The decline tells us they're making less profit on each sale. And overall, this is a clear indicator of a less healthy business this year. What's important to see a full financial picture. They have some income and loss, but it's not a large part of the business. This number is largely overshadowed by what's going on the income statement. One thing to note is there were cash dividends or payouts of company income declared on both Class A and Class B stock. The amount decreased compared to the year before, but overall shareholders' equity, what is left for the owners after all the liabilities are paid off, is up. Let's check the pulse of the company's money flow. Cash flow from operations shows the net increase or decrease of liquid money due to the operations of the company. The first quarter they pulled in $153 million, but for the first quarter last year they had negative cash flow of $153 million. We can see a bit where that cash went, which include purchases of equipment, properties, and proceeds from sales. In the first quarter, they spent about $96 million, spending a lot less than the year before when they spent $69 million. Let's check how they paid for some of those investments, as it was negative about $56 million in the first quarter. This means they're primarily paying off debt and buying back shares. This is in contrast to the first quarter last year. This is a difference in approach. Instead of borrowing money to finance operations, they focus more on paying down debt. Okay, time to hit the notes. The financial statements are like the highlights, but the notes show deep into the details. It's important to remember a few points such as the principles of consolidation. This explains how the company accounting occurs across subsidiaries. One key one here is that they talk about earnings per share calculation. Here is how they derive their basic and diluted earnings per share. A key component of their financials is it says the company uses certain estimates to understand the value of certain financial instruments. However, the debts are variable, so it is hard to measure. This company operates with a single operating segment called the truck segment. There are a couple of other areas that the company operates in, such as retail tire sales and insurance services. However, the primary source of financial actions is through truck sales. Lastly, in the notes, let's focus a bit on the loan situation. The explains a bit more about what they owe to vendors. They also need to account for any customers that might not be able to pay them back. All right, with the hard numbers out of the way, let's get to management's spin on all this in the section called. This section provides insights from the people at the top about what's been happening and what they expect to happen. Management notes that they're in compliance with all their loan covenants. Management provides and they expect the freight market to continue being under pressure. New class truck sales are forecasted to decrease. They expect to be down more than 10%. They do not plan to increase their volume significantly and plan to maintain market share of between 5 and 6% for heavy and medium trucks. With aftermarket and services, which is the primary driver of their gross profits, they expect it to be flat or down 2%. Now let's wrap it up and assess where Rush Enterprises is headed. Based on these numbers and management's guidance, it seems there are reasons to be cautious. The good figure for cash flow from operating activities is impressive continued commitment from the board to pay out dividends to shareholders. This can provide reassurance that they are on the right track. The bad trade, shrinking revenues and squeezed profit margins, this tells us they're selling less for more. The risky the external forces are massive with new environmental standards, tariffs and interest rates that are outside the company's control. Its heavy dependence on used trucks and services, which means a reliance on already broken trucks that is high margin but may not be sustainable. Overall, the numbers for the first quarter for Rush Enterprises look shaky. It's important to remember this is just a snapshot in time and things can change quickly in this industry. It does seem like it's going to get worse. However, alright, that's our breakdown of Rush Enterprises' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.